This is the Insight Empire, your number one source of Forex trading insights, and I am the Blue Bull Forex, and I am making this video at the Blue Bull headquarters. This is where retail hustle meets with institutional dominance, and I'm here today to talk about one of the most powerful trading strategies, especially for novice to intermediate traders who just are looking to get profitable in the market space, or people who have been trading for a period of time and they don't have a working age. And here we are talking about something that is very famous, but one of the most misused approaches to trading, and which has triggered so many of the traders to become much more unprofitable. So today we're going to be talking about how do we do it the right way. And if you stick with me to this video, you are likely to learn a simple working strategy that you can be able to use every now and then, and mostly probably get trading setup that are simple, transparent, and high quality, precise entry points, so that you don't keep on blowing account every now and then. And before I even continue to this particular video, why should you listen to me? My name is Blue Bull Forex, and I have been trading for the last 6 years, every day, Monday to Friday. I've looked at the charts, and besides this, I've also been able to help over 4,000 people to be able to learn how to trade, and most of those particular individuals have been profitable over time. Those who were consistent and disciplined enough, because honestly, if we have to talk about trading, it is never a walk in the park, and some people start with a lot of hype, and then quite often they give up. This is because discipline is what fosters consistency, but quite often motivation does not. So today I am not here to motivate you. I'm here to show you an approach that once you can maximize on that particular approach, there is a high probability that you might be a profitable Forex trader. So let's do this, guys. Now, to begin with, what are we talking about today? We are talking about trends and the trend line. Very important. Trends and the trend line. And the first thing that I want you to note before we continue with this particular session, I want you to note that the market is not directional. The market is not linear, the market is directional. The market is not linear, the market is directional. So that is the only statement that we will be trying to decode across this particular session. All right, so when we say the market is linear and not directional, when we say market is directional and not linear, basically what we're trying to mean is the market moves in this kind of a cycle. A market moves creating a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows in this particular manner. All right, now in this particular market, this market is not following a straight line, but it's following a very predictable direction, which is an uptrend, what now at institutional angle we would call now tactical ascension, right? So this is an uptrend, or basically what we call a bullish market. Amazing, very well. Now, this is to mean that this market does not move in this particular manner. It does not, just move in a clear straight path. It goes by having a series of pullback, and this particular pullback are very important because they are the ones that give us possible entry points. Now, there are some of the things that you have to note down when you are trading based on the trends and the trend line. The first thing, which is very important, is understanding the big time frame, or the higher time frame order flow or bias, what is basically we call the institutional intent. What are the institutions? Because the idea beyond the trading any strategy that I will ever give you guys, it is that we have two market participants. We have the retail traders who trades at the retail capacity, and then we have institution who I believe they trade at the institutional angle. And because retail traders do not have enough market command to push the market in either of the ways, I believe that most of the big directional movement is engineered not from retail level but from elsewhere, probably from the institutional vantage, and that is exactly what we are talking about right here. All right, so understanding the higher time frame bias or institutional intent is basically what we are calling institutional intent is the institutional call order flow. Where are they taking their orders? Where is the orders flowing to? Are they taking the orders downwards? Is the order flow going upwards? Is it on a straight, what we call a consolidational range? What is the higher institutional advantage? Now, the market is either doing three of these things. The market is either going up, now what we are calling the uptrend, bullish market, or the tactical ascension, or a market is either going down, which we call now the bearish market, downtrend, or a tactical descension, or a market is either consolidating or ranging within a specific range. Now, here is the catch. Research says that most of the accounts are lost in a consolidating market other than on a market which is on a clearly defined range. So I always recommend that in case you find a market is consolidating, is ranging in a specific direction, it is important, it is critical, it is key you avoid that particular market, because there is a high probability that you're not going to catch either of the significant movement unless it is a big consolidation from a bigger time frame, the market respecting a specific zone, either a equal high or a equal low that you can really count on. But high probability, I highly recommend you trend with the trend where the market is flowing into, and you follow that specific direction. So now, if we talk about understanding the bigger time frame order flow, or in the bigger time frame institutional buyers, we are trying to decode what is the big time frame market going, because there is no big difference between smaller time frame market and big time frame market. The only difference is the amplitude of the candlestick, but they are all the candlestick, either 1 minute candlestick, 5 minutes candlestick, 1 hour candlestick, or 4 hour candlestick, even the daily candlestick, they are all formed on the same philosophy, which we call the chaos. There is something we call the chaos theory, all right? So the only difference between 1 minute candle and 1 hour candle is the amplitude, which is basically the displacement per pip of that specific candle. But then the bigger time frame is very much important, because the smaller you trickle down in terms of the time frame, the more noisier the market becomes. So it is very, very hectic for you to analyze the market in 1 minute time frame or 5 minutes time frame. The reason being, the smaller the time frame, then the more difficult it becomes for you to be able to capture any specific market direction, because the smaller time frame are very, very noisy trying to do the construction of the bigger now time frame candlesticks that I highly recommend that you watch for this particular approach. Now, once you understand the bigger time frame order flow, the second thing that you need to do is now create a narrative following the trend. Create a narrative following the trend. Now, how we mean by creating the narrative following the trend is you start looking for possible reasons why market would basically either continue or reverse from that particular bias, but guided by a specific point of interest. And a point of interest can be an order block, can be a fair value gap, can be a breaker block, can be a liquidity void, can be a rejection block, can be a hold high or hold low. All those institutional reference points can basically serve as points of interest. And if you don't know either of the 7 institutional reference points, can you please check over on my videos, because I made a video explaining each of these particular institutional reference points, from the order block, the fair value gap, and all of them. They are very critical in ascertaining your entry criteria, because they give you an exact market position where you're supposed to trade from. If it's an order block and you mark that order block and the market violates the order block, actually you don't have any other reason to continue holding, and so you exit manually to save your capital. And that discipline is what long run counts to a profitable forex trader. All right, so you create a narrative following the trend. This is supposed to be narrative following the trend that you have seen in the bigger time frame based on the market flow. And then now the third thing, which is very critical, is to identify reversal zone. Okay, identify possible pivots. What we mean by a pivot is basically a turning point where the market is likely to turn from right. Now, let's assume the market is forming something which is very powerful, and that is one of the things that I want to talk about in this video, is forming a channel. Okay, that is something we call a channel. Very important. in trends and trend lines. All right, market is forming a channel. And what is a channel? I want to show you what is a channel. So if the market is going in this particular format, creating a series of higher highs and higher lows, you will discover that if you draw a line from this particular point, you just draw a line like that, you can show that is like a channel of some sort that this market is trying to follow in its movement. All right, so a channel can be a bullish channel, like this one. It's a bullish channel. For example, if you look at this, assuming that the price is perfectly respecting these particular zones, so you can see this is a channel that the market is using to go up. Right, there is a specific points where the market is channeling its order flow from. All right, it can also be a bearish channel. For example, the one that you can see here, I'm attempting to demonstrate. And this kind of a channel, basically, we call it a bearish channel. All right, trying to draw one here so that you can see for the sake of demonstration. All right, I'm not a very good at craft guy, but I try my best to demonstrate this. Or even it can be a channel of arranging market. So if a market is arranging within a specific point, all right, like that one, then you can also have a consolidating or arranging channel, all right, arranging channel of this particular format. So anytime the market comes to a possible pivot point, because now this is the third thing that we're talking about. Anytime now the market comes to a possible pivot point like this one, you are supposed to enter for a short position. Short means basically you are going to sell. So if the market turns, for example, the previous point where the market reacted to the channel, it is always a possible pivot point for the next turn up. So what you're supposed to do is you're supposed to look for these particular points, like this point over here. All right, let me mark out these points. This can be easy. All right, so you are supposed to look for these particular points. These particular points are possible reversal points where the market reversed initially. So this means when the market comes here, of course the market will high probability be pivoted upwards, and once it comes here, it will basically find its fulcrum to the previous low. Right, so in this case, this would be our perfect explanation or expectation. So once the market comes here and we see it is reversing from here, then it would target that particular zone and then probably reverse again to this particular zone. So this is where the channel is, where you're drawing your trend line, is where your channel is. Remember, the topic of this video is trend line trading. It's about trends and trend lines. So basically you are supposed to execute either a buy position at this particular point, and then you put your stop loss below the channel, and probably you target the previous point where the market is supposed to reach for the next channel. All right, and this is always going to give you 1:2, 1:3 risk to reward ratio, depending on your anticipation and all that. Very amazing way of trading, especially for complete beginners. This is one of the strategies that I used to pass pro from back in the days. I don't use it right now because I consider it more of a novice strategy. But I have discovered one thing. Right now we have a flock of people, a lot of people who have gone basically so deep and technical, talking about the deep concepts of trading, volume, spread analysis. I'm not against that, that's amazing, but at some point it comes now to simplicity. Once you discover that what you think is complex, it's only complex on paper, but when it comes to translation of those complexities, you discover that you are not making any money. So right now, this year, especially for 2026, it's all about making it simple and easy for you to understand, right? A simple system traded with discipline is supposed, or is high probability likely to give more returns than a complex looking professional Wall Street language strategy that cannot yield anything when it comes to your MT5 history. So we wanted to see a positive PNL, then you're supposed to embrace simple strategies that almost everybody else has missed out on them, and now is looking, chasing those big terminologies, thinking that is where profitability is. And I'm here to tell you the truth, because I have been in trading for the last 6 years. I've done all these strategies. I've also gone to intermediate strategies. I've covered ICT concepts, SMC concepts, understood all SMT divergences, understood market maker buy models and sell models. I even learned Elliott wave theory, market mechanics. I understand depth, order book, reading those depth of market and all those things. I know they are very important, very appealing, but right now in 2026, it is about simplicity and money in the pocket first, before we talk about complex trading jargons and linguistics which are not yielding anything for you. So this is a strategy that I would highly recommend that you adopt, and maybe to give to shed light on one of the things or circumstances under which this particular strategy may fail is anytime you see a market coming, for example, and then it happens to close with a body. All right, anytime you see because right now I'm talking about the entry criteria for this particular approach. Now let's assume this is the channel that you are trading, all right? This is the channel that you're interested in trading for this particular day. So once the market comes here, of course, you are looking for a possible sell opportunity, targeting the previous support zone, because the market got resistance up there. So what you're going to do is you are waiting for one thing. If you see the market break this particular point completely and closes with a body, then you do not enter the market. Also, you do not enter when the market just touches this particular trend line. So what you do is you wait patiently and you see the next candle. If the next candle closes inside the range and closes with a body to indicate there is a possible momentum to push the market downwards, then this is what we call waiting for a confirmation candlestick. So you don't just jump in just because the market touched here, otherwise it might break here. And guys, I want to tell you something from my own experience and introspection from the charts. The candle that comes to break a specific zone, most of the times it is a very volatile candle with a lot of momentum. So you might just enter here and then we have one huge candle that is breaking completely this particular zone, and then you get blown out. So you want to wait until this candle closes. It can even go up, print a wick. It can even go up, print that kind of a wick to the upside. And then completely it decides to reverse downwards and close somewhere there. So actually now these 3 or 1:4, that is amazing if you trade with that particular discipline. Guys, I tell you guys, most of the problem is most of the people just want to enter exactly the market touches their point of interest, which is a possible pivot point. And that is one of the mistakes they do, because this game is about 90% waiting and 10% execution, but most retail traders does 90% execution and 10% waiting, and this explains why a report from the Capital Markets Authority indicates more than 90% of retail participants who participated in the financial markets quite often end up losing their accounts. All right, so if you want to be in the top percent, then you have to embrace what the 90% are not doing. I am the Blue Bull Forex. Of course, you are number one best mentor and coach in Forex trading. This game is about 90% waiting and 10% execution, but most retail traders does 90% execution and 10% waiting, and this explains why a report from the Capital Markets Authority indicates more than 90% of retail participants who participated in the financial markets quite often end up losing their accounts. All right, so if you want to be in the top percent, then you have to embrace what the 90% are not doing. I am the Blue Bull Forex. Of course, you are number one best mentor and coach in Forex trading.